What should you expect from the UK property market in 2023? Hi, it's Chris here from Property Abundance, and in this video we're going to unpack this question and look at what 2023 could mean for the UK property market. Now we're going to look at this from two perspectives. The first is sales and what's happening with house prices, and the second is what knock-on impact does that then have onto the rentals market. So let's dive straight into this, shall we? Now, to understand what's happening right now in the sales market, we need to understand a few macroeconomic factors. Now, what I mean by macroeconomic factors are things that happen to the wider economy that influence this house prices. Now, the first economic factor we want to talk about is interest rates. Now, right now in the UK, interest rates are the highest they have been in well over a decade. Okay, we had an entire 10-year period where interest rates were artificially low. Now that meant that people took out bigger mortgages that they couldn't necessarily afford if the rates went up, and now are left in a position where they can't afford the repayments because right now interest rates have gone up. At the time of recording, the average property interest rate for a mortgage is going to be around about 5.5% to 6% per year. So with higher interest rates, means it's much more expensive now to own property. So if it's more expensive to own it, the amount of demand for that commodity, in this case housing, falls. So the higher interest rates that we have right now is a negative for house prices in 2023. The next one we want to talk about is inflation. Now again, inflation, if you don't know what that means, is the rate at which things go up in price. Okay, the rate at which things become more expensive. Now, where does this relate to property is in terms of disposable incomes. Now, the more disposable income people have, the more that people have to spend, the more they have to invest. And if they have more to invest, then it means that they can do more investing, naturally, right? So if you have higher inflation, this means that people have less to spend at the end of each month because the cost of their rent's gone up, the cost of their mortgage has gone up from the interest rate, the cost of the electricity has gone up, the cost of gas has gone up, council taxes are up, all these prices are up, which means that people have less to spend and therefore invest at the end of every single month. So that means that they will have less to invest in property, and people with less to invest in property buy less property. It's as simple as that. So again, both these two factors are demand reducers. Okay, so they reduce the amount of demand in the market. Now, by the way, if you're finding this kind of video useful, where you get regular content like this, if you find this kind of dive into industries and top tips from the property industry and from my own property business useful, please do me a favor, give this video a thumbs up, give it a like, drop a comment once I've finished. What was your favorite explanation? What was your favorite macroeconomic factor we spoke about today? And make sure to click that subscribe button. It really helps us out with the channel. So let's dive into the next one, which is a recession. Okay, now, right now, all over Europe, people seem to have bounced back. But here in the UK, we have a more pessimistic outlook on the economy than the rest of the EU. Now, that could have a good factor, or it could be a bad factor. Let's explain both. It's a bad factor because obviously the more people think there's going to be a recession on the cards, the more likely they are to try and draw in their horns, try and invest less, try and spend less. So that has a demand reducing effect on investments as a whole. However, there is a flip side to this because people still want to invest even during recessions. They just want to avoid things that can go down a lot. Now, property is always viewed as a more safe investment than things like stocks and shares or crypto, or any of these more volatile investment models, commodities, etc. So, as property is a safer investment, you haven't got the expression safe as houses for nothing, right? As it's a safer investment, that can mean during times of recession, you actually get more people who would otherwise invest elsewhere now looking at property as their safe kind of go-to investment during times of uncertainty. So it could be a demand reducer, or it could be a demand increaser. Now, I would say from an owner point of view, where people buy their own houses for themselves, it's going to be a demand reducer. And for small-time investors, it will also be a demand reducer because they'll have less liquid capital to be able to invest into things. But for larger institutions, for hedge funds, for investment funds, property can be a bit of a safer place to go during these times of uncertainty where they're not sure what's going to happen on the FTSE 100 from a day-to-day basis because who knows what's going on. So it could be either. Now the fourth one we want to talk about today is what we call the affordability matrix. Okay, now this is... Okay, so an affordability matrix ratio. So this looks at the earnings, people's average earnings versus the average price of property. Now, right now in the UK, we are at a dangerously high earnings to price ratio. Now, what I mean by that is that the average salary that people earn is dangerously low compared to the average house price. Okay, right now in 2023, the average house price is £264,000. But the average salary is about £26,000. So there's around about a 14 times multiplier there. So if we've got a 14 times multiplier, we have not had this situation since before the First World War. It's over 100 years ago that we had this kind of earnings to price ratio. And it's actually very dangerous because it means that less and less people can afford to buy a property. Now the fourth one I want to talk to you about today is called our affordability ratio. Now here, we need to look at the average price of a house versus the average salary. So we're looking at earnings versus price. Now this is a really key metric to understand in the property industry because this has a huge impact on the amount of demand there is for housing, or the more to the point, the ability for the population as a whole to afford to buy their own house. Now right now here in the UK, we are on about an 8 times multiplier. Now by that I mean that people have to save up 8 years of their earnings to afford an average property. Now right now in the UK, the average income is around about £26,000 a year. The average house price is about £260,000 a year. So that means people have to save up 100% of their salary for 8 years for the average house price. Now obviously you get deposits and you don't need to save up the full amount, but this has a massive impact on the amount of people that can afford to buy houses because you still need to save up a deposit, even with products like mortgages. So if we have a multiplier of 8 times, we need to look back in history and realize that we haven't actually had this high of a multiplier since before the First World War. So that is over 110 years now. Well, it's 109 years actually, since the start of the First World War. So in that period, house prices have always been lower than 8 times multipliers. And very recently we see this big upward trend in the house price to earnings ratio. And now any upward trend is dangerous because when you get a spike, you get a crash. So I'm watching this very carefully at the moment. I'm watching the fact that house prices are already in decline here in the UK right now. I'm wondering, is this the time actually where this earnings to price multiplier has finally caught up with us and we're going to see a bit of a slump in the market? It's certainly something to watch. Now, on the flip side, these are all negatives, right? Apart from recession, which could be a positive, could be a negative. But let's look at some of the positives here. So we still have net migration into the UK here. Now, in 2022, 500,000 people came to the UK. Okay, so that was our net migration. Once you count for all the people that moved in versus all the people that moved out, we had a net gain of 500,000 people. And yet we had houses built, or dwellings I should say built, because a flat is obviously not a house, but it is a dwelling. Dwellings built, dwellings of 204,000. So we can see it doesn't take a genius to work out there's approximately, well, it's not approximately, it's 296,000 fewer dwellings than there need to be. So you've got 500,000 people come to the country, 204,000 new dwellings built. There is a shortfall of 296,000 dwellings. Now that obviously again has a massive impact on prices because there is an undersupply in this market. And the UK, because of the fact that it's a small island, land prices are expensive and people aren't building enough houses anywhere in the UK, there is always this shortfall in houses versus our migration numbers every single year. Now that compounds over time. The longer it goes on, the worse it becomes. And that has a positive impact on prices because you have more people wanting houses than there are houses available. Therefore, prices go up. Now, all of this taken together, what do I think is going to happen? I think, and again, happy to be wrong on this, but hopefully I'm right. I think that this will lead to less appetite to buy houses for investment purposes in 2023. Therefore, I think with less appetite, I think we will see house prices reducing, and I think that that will continue for a good few months before stabilizing. And I think we need to see this earnings to price ratio come back down to something more realistic before the market will stabilize. What does that mean in terms of percentage reductions? I don't know. I wouldn't want to put money on it. But I think taking all these macroeconomic factors into account, the fact that interest rates are super high, the fact that inflation is really high, and the fact that we are on the border of a recession with a very high earnings to price ratio, despite these offsets here in a constriction of supply, I think we are still in for reductions within 2023. Now that can be a really good thing or a really bad thing. Now if you're looking to pick up a bargain, a falling market can be brilliant in terms of being able to negotiate hard on the prices. However, if you're looking to do a strategy like buy, refurbish, refinance, where you buy a property, add a load of value to it, and then get it revalued at the end, and all the while that you're doing that, the value of this house is actually going down, that can be a terrible thing. So right now, we have a buyer's market. So, if you want to learn how to buy houses, now is the time to do so because you can put offers in and offers are being accepted right now at well below asking. It's a very good buying opportunity. Not necessarily a great selling opportunity and not necessarily a great development opportunity, but the great thing about houses is that they stand for a long time. So if you were to buy something now with an opportunity to add value to it, with an opportunity to develop it at a later date, now is the time to be doing so. So let's consider now what this actually means for the rental market as well. Because anything that happens in the sales market, the purchasing market, affects the rental market as well. So we've still got these two big pressures. We've got inflation and we've got interest rates. Now these both impact the rental market as well. Inflation first. Now how does inflation impact the rental market? Well, firstly, if landlords are experiencing high cost of living, if they're seeing the cost of their maintenance bills go up, they're seeing their agency fees increase, all of this is inflationary pressure on them. Now, again, to understand these two and how they impact this, we need to consider how landlords actually make their money and set their prices. So if this is the market price right now for a property, what makes up that market price? Well, firstly, we've got the mortgage. Okay, their single biggest expense in owning a property will be the cost of finance. On top of that, we've got things like our operating costs, like agency fees, maintenance costs, etc. Now, if agency fees are going up and maintenance costs are going up, that's going to start eroding this profit section. Now, this is the part at which they actually make some money. So if agency fees and maintenance costs are going up, that's starting to erode their profit margin. But add into that the fact that interest rates are now also higher, meaning that their mortgage is going up as well. Well, now we're starting to see a serious eroding of these profit margins. Now, imagine if the owner of this property is actually quite reliant on that profit to sustain their quality of life, their standard of living, and pay their bills. The only way that they can maintain this profit margin is by putting the prices up. And that's when you start to see this inflationary effect hit the rental market as well, because their costs are going up to maintain their profits and to continue making a profit and to make property a viable investment for them. They have to put that price up, and we're already seeing this in the rental market. Okay, prices for standard rental units are on the up across the board because of interest rates going up and also inflation, meaning that the agency fees and maintenance costs and other just general operating expenses are on the up as well. So inflation leads to prices rising, interest rates lead to prices rising. But there is an extra sector that is particularly affected here, and that is HMO rooms. Okay, let me explain why. If inflation is on the up and you're currently living in a 2-bedroom flat that you rent, let's say you can just about get by paying your bills, covering your rent, and kind of living your life. But then inflation starts going up, and all of a sudden your salary doesn't quite go as far. You know, your bills have gone up, your electricity's gone up, your gas has gone up, your Wi-Fi's gone up. All these extras mean you need to find savings somewhere. So people will look at their costs and go, well, how can I reduce my cost of living? So if you're in a 2-bed, they might instead rent a 1-bed. If you're in a 1-bed, you might instead rent a studio. But if you're in a studio, the only way to go down and reduce your cost of accommodation from that point up to go into HMOs, where you rent the room with all bills included. So whenever you get a situation like a recession, like a period of high inflation where people's costs are strained, you get a lot of demand towards the bottom end of the market. So studios and HMO rooms are experiencing a lot of demand right now. Now with extra demand, if demand goes up, price follows. So again, we are seeing even more than just on the standard rentals, within this lower end of the rental market in HMO rooms where people have a large demand for this cheaper form of accommodation, prices are on the up. And again, we're seeing this within our own portfolio right now as well. So I think this will continue to happen throughout 2023. I think prices, whatever interest rates are higher, whatever inflation is at the rate it is right now, we will continue to see these price increases. Now for you, that is an opportunity, because there are now more than ever, there is an equal playing field for people to be able to get into property. Now, if you want to learn how to do this yourself, if you want some bespoke advice based on you, your situation, and where you want to get to with it, we are offering some free 30-minute consultation calls with my team personally. All you got to do is click on the link down below in the description and you can book one of those in. Now, on that call, we'll spend 30 to 40 minutes with you, understanding where you are right now, what resources you have available to invest, and then we'll give you a bit of a roadmap for what your next steps should be based on what you want to achieve. So go ahead and get that booked in right now. I hope you found this really, really useful. I hope my predictions are right. I guess time will tell. Let's review this in a year and see where we got to. But if you found this really useful, please drop a like on it. Please comment what your biggest takeaway from this was. And make sure you subscribe to the channel to stay up to date with the latest advice straight out of my own 7-figure property business. Other than that, guys, have a great day and I'll see you in the next video. Bye-bye.